BlackRock just quietly moved trillions of dollars and almost nobody is talking about it. I'm not talking about rumors. I'm not talking about opinions or scary headlines. I am talking about trillions of real hard cash being shifted right under our noses. And this specific move signals the start of a massive wealth transfer. We are talking about $11 trillion in asset management. BlackRock is not just a hedge fund. It is not a YouTuber with a hunch. They are the largest asset manager on the entire planet. Think of it this way. If the stock market is an apartment building, BlackRock is the landlord. They own a piece of almost everything. They are in your 401k. They are in your pension. They are everywhere. So when BlackRock decides to relocate capital, they are not guessing. Larry Fink knows a whole lot more than we do. This move is not based on emotion. It is based on math. It is based on policy. And it is based on probability. And here is what just happened. BlackRock shifted massive exposure out of the United States and moved it toward emerging markets and international assets. That does not mean America is collapsing tomorrow, but it does mean that returns are rotating. Money flows like water. It always goes where it can grow the fastest. Retail investors, that's us. We tend to react to headlines. We see the news, we get scared, we sell, or we get excited and we buy. We are reactive, but institutions, they move before the headlines are even written. They can do this because they have armies of analysts doing deep research that we just do not have access to. They have data sets that cost millions of dollars. But here's the cheat code. We do not need their data. We just have to pay attention to their hands. We have to watch what they do, not what they say. Because if you do not know that money is moving, you are flying blind. By the time CNBC or Bloomberg explains this trend to you, the trend is already crowded. The profit is gone. So the question is not, is the US market bad? The real question is, where is the new growth coming from next? Markets do not reward loyalty. They do not care if you love American stocks. Markets reward positioning. And that is why what I am about to show you is so powerful. In this video, I'm going to reveal exactly where that money is going, why it is happening right this second, and how regular investors like you and me can position ourselves before this shift becomes obvious to the rest of the world. Why money is rotating out of the United States right now. Let me show you the numbers that Wall Street does not want you thinking about too hard. In 2025, international markets crushed US stocks. The MSCI Emerging Markets Index returned about 30% in 2025. The Morningstar Global Markets ex-US Index surged about 32% in 2025. And the MSCI ACWI ETF, which tracks global stocks outside the US, is up 20% over the past year. Now look at the S&P 500. It did about 17.9%. 17.9% is good. We like positive returns. It is not bad. But when you look outside America, you realize you might be leaving money on the table. International markets nearly doubled the returns of US stocks in 2025. This is not a one-month blip. This is a structural shift. International equities began to outperform the US in November 2024. And since that turn have beaten US equities by roughly 15%. While that does not erase the decade of lagging returns, it marks a meaningful inflection point. But wait, there is more. Greece's Athens composite surged nearly 44% over 2025 and will be upgraded to developed market status in September 2026. Chile and the Czech Republic's benchmark equity indexes are both up around 50.8% year-to-date. Romania's BET index has gained more than 42%. This is not just one country getting lucky. This is a global rotation happening in real time. Here is what is driving this. The US dollar is weakening, and when the US dollar gets weaker, foreign assets get an extra boost. We call this a tailwind. Think of it like running a race with the wind at your back. You run faster without using more energy. When you invest in foreign markets during a weak dollar cycle, you do not just earn money from the stock going up. You also earn money because the foreign currency is worth more than your dollar. It is a double return. You win twice. The US dollar fell over 9% in 2025, its worst annual performance since 2017. The dollar index, which measures the greenback against a basket of currencies, fell about 11% in the first half of 2025. Morgan Stanley Research estimates the US currency could lose another 10% by the end of 2026. From January 1st to December 17th, 2025, the dollar lost 9.5% of its value. Pushing down the dollar's value has been a policy priority for the administration. And analysts anticipate that the next few years will see a secular bear market for the dollar as investors diversify away from US dollar-denominated securities and central banks reduce their treasury holdings. This is not just theory. This is measurable reality. Global non-US equities outperformed US equities by 6.6 percentage points in local currency terms in 2025 and by 13.9 percentage points in US dollar terms. That currency effect is massive. That is the tailwind working in real time. The dollar collapse driving the rotation. Let me show you exactly why the dollar is weakening. It is not a mystery. The reasons are mathematical and undeniable. First, interest rate policy. The Federal Reserve cut interest rates in 2025 and is expected to cut them further in 2026. The Fed is likely to reduce interest rates from the current range to as low as 2.5% by the end of 2026. Because rate differentials are a fundamental driver of currency strength, the more that US interest rates fall to match the levels of its peers, the more likely it is that the dollar will weaken. Think about it. If you can earn 5% on a European bond and only 2.5% on a US Treasury, where would you put your money? You would put it in Europe. That is exactly what is happening right now. In January 2026, global capital saw a net outflow of $18 billion from the US Treasury market and $22 billion from the US stock market. Significant capital shifted to the Eurozone and emerging markets where interest rates are relatively higher. Second, political pressure and uncertainty. Political pressure from the Trump administration on the Fed has become a significant driver. Trump has repeatedly called for the Fed to accelerate the pace of rate cuts to stimulate economic growth, raising concerns about the central bank's independence and further shaking market confidence in the dollar. A criminal investigation was even opened into Federal Reserve Chair Jerome Powell. Whether that investigation has merit is irrelevant. What matters is the signal it sends. The independence of the Federal Reserve is being questioned. The institution that manages the world's reserve currency is under political attack. That is not bullish for the dollar, that is catastrophic for the dollar. Third, the debt crisis. The US debt crisis continues to ferment, with federal debt exceeding $37 trillion, or over 130% of GDP. In January 2026, the auction yield for 30-year Treasury bonds rose as demand for US debt fell, weakening the dollar's credit backing. US government debt as a percentage of GDP now exceeds both China and Europe, constraining future policy options. This is the debasement trade. Governments are now forced to let inflation steadily eat away the real value of their currencies over time. Fourth, de-dollarization is accelerating. The de-dollarization trend is accelerating as countries reduce US Treasury holdings in favor of gold and other assets, driven by concerns over the weaponization of the US dollar and attacks on Fed independence. The de-dollarization process accelerated in January 2026. BRICS nations announced they would increase the share of internal trade settled in local currencies from 35% to 50%. ASEAN plans to establish a regional unified payment system by 2027 to reduce reliance on the dollar. And the share of local currency settlement in Brazil-China bilateral trade reached 40%, up 10 percentage points from last year. The dollar's share in foreign exchange reserves has declined. USD assets, principally liquid treasuries, account for the majority of allocated foreign exchange reserves. However, demand for treasuries has stagnated among foreign official institutions. The dollar's share of disclosed global currency reserves was just under 57% as of the third quarter of 2025. That is down from over 70% 2 decades ago. While foreign investors remain the largest constituent within the treasury market, their share of ownership has fallen to 30% as of early 2025, down from a peak of above 50% during the global financial crisis. This is the environment BlackRock is reading. This is the data they are responding to, and they are moving capital accordingly. What BlackRock is actually doing. Now let me show you exactly what BlackRock is doing with this information. BlackRock's 2026 investment outlook explicitly mentions a move toward widening country dispersion and an international focus. They're actively looking at opportunities in Japan, Europe, and emerging markets like Brazil and India where they see better value. BlackRock is underweighting long-term US Treasuries. Because the US national debt reached approximately $38 trillion by late 2025, BlackRock and other major institutional smart money players have shifted away from long-term government bonds to avoid risks related to interest rates and fiscal debt. While they are reducing exposure to certain U.S. government debt instruments, they remain overweight in U.S. stocks, particularly those tied to the artificial intelligence boom. But the key is what they are adding. They are adding international exposure aggressively. Emerging market equity strength has carried over to 2026. The MSCI Emerging Markets Index notched a nearly 9% gain in January 2026, its best January clip since 2012, and one of its largest monthly gains in recent years, easily beating the 2.2% gain in developed market stocks. BlackRock expects both emerging market stocks and bonds to be supported by resilient global economic growth and a stable to softer U.S. dollar. Solid global growth is one of the broader drivers they see supporting emerging market returns, along with both major and emerging market central banks, including the Federal Reserve, easing monetary policy. BlackRock prefers emerging market hard currency debt and stays selective in emerging market equities, preferring stocks that benefit from megaforces like AI. They think such differentiation among emerging markets rewards an active approach and being selective. Let me be very clear. This is not about abandoning American stocks. BlackRock is not telling you to sell your entire portfolio. This is about diversification. It is about recognizing that leadership in the global economy is changing hands. I want us to pay attention. I want us to see the wave before it crashes on us. The emerging market explosion. Nobody saw coming. Here is what makes this so powerful. Emerging markets are not just beating U.S. stocks, they are crushing them by historic margins. And the best part? Most investors still do not know this is happening. South Korean stocks have surged more than 20% after last year's big gains. India is still lagging even with the recent U.S. trade deal, but BlackRock sees opportunity there. The MSCI Emerging Markets Index returned about 34% in 2025. Latin America was the standout performer in emerging markets, with a 37% year-to-date return on equities. The region is expected to offer further outperformance potential, supported by deeply discounted equity and currency valuations and improving macroeconomic conditions. Why does this matter? Demographics. These countries have young populations. Young people work. Young people spend money. Young people build things. In the US, our population is getting older. In these countries, the workforce is just getting started. Emerging markets are key to the AI build-out from industrial metals to manufacturing supply chains. Copper and other critical industrial metals essential to AI infrastructure are predominantly sourced from emerging economies. South Korea and Taiwan benefit from their strength in manufacturing AI hardware, especially semiconductors. In China, BlackRock favors leaders in AI, automation, and renewable energy, which are part of China's new economy. The rewiring of global supply chains is benefiting Mexico, Brazil, and Vietnam. Here's the kicker. Emerging markets are trading around average valuations on an aggregate basis and at a 45% discount to the S&P 500, which is a record high discount. Read that again. Record high discount. You are getting the same growth, the same earnings potential, at almost half the price. The cyclically adjusted price-to-cash earnings ratio for the MSCI USA Index was 2.19 times higher than the MSCI Developed Markets Index, representing a 50% premium to its long-term median. U.S. stocks are historically expensive. International stocks are historically cheap. Why? This is only the beginning. Now here is where it gets even better. This is not a temporary bounce. This is the start of a multi-year cycle. Since 1971, we have observed 6 completed dollar cycles with an average duration of about 8 years. If we are at the beginning of a longer-term cycle of dollar weakness, portfolios need to be reconfigured. Goldman Sachs raised its forecast for the MSCI Emerging Markets Index, which it expects to reach 1,480 over the next 12 months. Goldman Sachs research predicts earnings from emerging market companies to grow 9% this year and 14% in 2026. JP Morgan's head of global and European equity strategy, Mislav Matejka, said the in-house view was that emerging markets were heading for a second year of outperformance in 2026, snapping years and years and years of trailing returns. Fund managers at investment management firm 91, which manages assets worth more than $203 billion, struck a bullish tone, suggesting more upside is likely in various pockets of emerging markets in 2026. L1 portfolio manager said the setup for emerging markets has not looked this compelling for 15 years. Think about the math. If just 1% of global equity markets shift to emerging markets, You are looking at $1 trillion of new demand flowing into these assets. And there is not enough supply at current prices, which means prices have to rise. A lot. The 3 ways to position for this shift. So how do you position yourself on the right side of this wealth transfer? Let me show you exactly what the smart money is doing. There are 3 primary ways to capture this rotation. First, broad emerging market exposure. The iShares MSCI Emerging Markets ETF, ticker EEM, has $26.55 billion in assets and has returned 42% over the past year. This gives you exposure to China, India, Brazil, Taiwan, and South Korea, all in one fund. EM returned about 34% last year. This is the tool institutions use when they want to make a macro bet. They are not betting on just Brazil or just India. They are betting that the entire world is going to grow faster than the United States. And right now, that is a smart bet. Second, developed international markets. The iShares MSCI ACWI ETF is up 20% over the past year, besting the S&P 500's return by about 5%. The Spider Portfolio Developed World ex-US ETF, which holds over 2,300 developed market stocks excluding the US, climbed more than 30% over the past year. This gives you exposure to Europe and Japan without the volatility of pure emerging markets. BlackRock sees Europe's 2025 winners, banks, defense, and industrials, being joined by a broader set of sectors in 2026 as Europe's economy shows green shoots of activity. Japan boasts a reinvigorated investment backdrop, spurred by inflation and a renewed focus on corporate profitability. Years of corporate governance reform and shareholder focus is starting to boost returns. Third, selective country bets. India is on the path to becoming the world's 3rd largest economy by 2030, with real GDP expected to grow at a 6% to 7% annual rate. BlackRock likes India on a stable political backdrop and strong growth prospects. Taiwan and South Korea benefit from their strength in manufacturing AI hardware, especially semiconductors. These are the countries actually making the chips that power the AI revolution. Latin America, which has been an underappreciated market for many years with valuations near 20-year lows, is offering further outperformance potential. Stronger commodity prices are a boon to Latin America. Why most investors will miss this opportunity? Here is the brutal truth. Most investors will miss this entire move. And I can tell you exactly why. Certainty is the most expensive thing in the world. Certainty only appears when the returns are already gone. By the time the water looks clear to you, the big fish have already swam away. BlackRock is not predicting the future. Larry Fink does not have a crystal ball or a time machine. He has probabilities. And that is the one thing that crushes the average investor. You are waiting for safety. You are waiting for the news to say everything is okay. But institutions, they are responding to currency shifts, policy changes, and growth data right now. If you wait for the all-clear signal, you are buying the top. When you see headlines about sell-offs or Trump talking about buying Greenland or drama at Davos, do not panic. Do not start pressing buttons and selling your portfolio. People panic. Institutions reposition. See, money never really leaves the market. It just moves tables. It moves from table A to table B. Pullbacks are just the big players moving their chips to a new game. And here's the golden rule you need to write down. Every global rotation feels uncomfortable before it feels obvious. I will say that again. It feels scary right before it becomes obvious to everyone. Right now, we are in that uncomfortable phase. The data is clear. The trend is undeniable. But it still feels wrong to most investors because they have been conditioned to believe that US stocks always win. But the scoreboard does not lie. International markets beat US stocks by nearly 2-1 in 2025. That is not a prediction. That is a historical fact. And all the evidence suggests this trend is just getting started. The wealth reset is already happening. Here's what you need to understand. This is not about being anti-America. This is not about abandoning US stocks. This is about awareness. You do not abandon the US, you just diversify intelligently. You find the right pockets. But ignoring a global rotation when the largest asset manager on earth is moving trillions of dollars, that is the real risk. You do not need to predict the future. You just need to follow the footprints in the sand. Position yourself early, stay patient, and let the system do the work. The market is designed to emotionally hijack you. It is engineered to keep you overstimulated. The algorithms, the red flashing numbers, the breaking news alerts, they are all trying to give you a traumatic experience with your money. The system wants you to look at your account, see red, feel your heart race, and then sell everything just to stop the pain. That is exactly what the system wants you to do. That is how wealth is transferred from your pocket to theirs. You have to resist the urge to react. Settle down. Close the app. Seriously, close it. Take a breath. Do the homework. Come back when you are focused, not when you are fearful. BlackRock just showed you where the money is going. The dollar is weakening. Emerging markets are surging. International stocks are beating US stocks by historic margins. Central banks are diversifying away from US treasuries. The math is undeniable. The trend is clear. The wealth reset has already begun. The question is simple. Which side of this transfer will you be on? The side that gets left behind holding overpriced US assets in a weakening currency? Or the side that positioned correctly, diversified globally, and captured the returns that the rest of the world is generating? If this video opened your eyes, if this changed how you see what is happening, you need to subscribe right now. Because what I just showed you is only the beginning. The data is clear. The institutions are moving. The wealth reset is not coming. It is already here. The only question is whether you will be ready when the rest of the world finally wakes up to what is happening. Share this video with someone you care about. Because the opportunity window is closing. The smart money has already moved. The question is, will you move with them? Or will you wait until it is too late?